When it comes to building wealth through the stock market, investors often ask about selecting the right ETF. In 2025, two popular ETFs are SCHD and VU, both from reputable providers. They offer efficient diversification. While they seem similar, they serve different investment philosophies. Your choice impacts wealth growth and return stability. VOO aims to replicate the S&P 500 index, covering 500 of the largest U.S. companies across various sectors. Investing in VOO means owning pieces of giants like Apple and Microsoft, linking your returns to major economic players. The S&P 500 historically averages a 10% annual return, which reflects market cycles and economic changes. CHD focuses on dividend-paying stocks, targeting companies with a history of strong, consistent dividend growth. Managed by Charles Schwab, SCHD holds around 100 companies that pay dividends and have strong fundamentals. The index filters for companies with at least 10 years of dividend payments and sustainable payout ratios. Enhances wealth growth not only through stock price appreciation, but also through dividends. In 2025, we're facing a different economic climate. Factors like high interest rates and inflation affect performance. The real question is which fund builds wealth faster, given the current market conditions. The S&P 500 often trades at higher price-to-earnings ratios compared to dividend-focused funds. SCHD screens for companies with solid fundamentals. In times of stretched markets, SCHD may provide better risk-adjusted returns. For investors worried about paying too much for growth, SCHD offers a disciplined approach. Expense ratios can significantly impact long-term compounding. VU has an expense ratio of about 0.03%. SCHD is at 0.06%. Both are low-cost options, but the lower costs of VOO give it a microscopic edge over decades. SCHD offers a dividend yield of 3% to 3.5%, while VOO's hovers around 1.5%. Over decades, this can lead to significant reinvestment gains. For retirees or those seeking income, SCHD provides a built-in paycheck, while VOO requires selling shares for cash flow. One of the psychological advantages of SCHD is that investors feel rewarded even during flat or down markets. When stock prices aren't climbing, dividends still arrive, softening the emotional blow of volatility. With VOO, patience is required because the returns are tied directly to the broader market's performance. If wealth is purely about maximizing net worth over decades, VOO might have the edge in high-growth environments. If wealth is seen as growth, income, and peace of mind, SCHD builds practical wealth faster. Imagine two investors, Alex and Jordan, each starting in 2025 with $100,000. Alex chooses VOO while Jordan chooses SCHD. After 20 years, if VOO delivers 9% annually and SCHD delivers 8%, Alex ends up with more in raw numbers. However, Jordan's wealth grows more smoothly, enjoying steady cash flow if dividends are taken as income. For younger investors, VOO may be the better play in 2025. Maximizing growth makes sense, and VOO provides the cleanest exposure to U.S. large caps. For retirees or those approaching retirement, SCHD is compelling, The yield provides income, and the companies are relatively stable. The debate between SCHD and VOO is about aligning with your financial goals. Both funds are efficient, reliable, and low-cost options. 2025 will test both growth and dividend strategies. Whether you choose VOO or SCHD, you're giving yourself exposure to America's corporate backbone. Holding VOO for growth while pairing it with SCHD creates a balanced portfolio that can weather economic cycles, offering the best of both worlds. Volatility isn't necessarily bad for long-term investors who understand compounding. For younger investors, it can create opportunities to buy more shares at cheaper prices. Historically, every downturn in the S&P 500 has been followed by a recovery, and those who stayed invested came out wealthier. Selling out due to fear at the wrong time has destroyed more wealth. SCHD offers a psychological edge. Dividends roll in during downturns. This difference affects real-world wealth building, since discipline and patience often matter more than theoretical returns. VOO is market cap weighted with technology dominating. If tech stagnates, that could hurt VOO investors. SCHD is more diversified across sectors. CHD spreads risk differently, which can help smooth returns when one sector falls out of favor. Imagine an investor holding SCHD who collects a 3.5% dividend yield in 2025. If they choose to reinvest, that yield means more shares purchased automatically every quarter. Over 20 or 30 years, this snowball effect can rival or even surpass the growth you'd see in a pure growth ETF. Academic research shows reinvested dividends often account for more than half of long-term returns. CHD's appeal isn't just about the current income, but about the compounding machine it creates quietly in the background. VOO's lower yield means you rely more on capital appreciation for wealth growth. This changes the nature of how your portfolio compounds. Tax efficiency is crucial. VOO is highly tax efficient due to minimal turnover, while SCHD distributes higher dividends, which can be taxed. For investors minimizing tax bills in 2025, this difference may tilt the scale slightly in favor of VOO. Some don't mind taxes on dividends for the reward. In a world where inflation lingers, dividend stocks act as a hedge. Companies that raise dividends can pass rising costs on to consumers. CHD's focus on dividend growers gives it an edge with companies that have pricing power, invaluable if inflation remains sticky in 2025. VOO includes a range of companies, and not all can raise prices as effectively. However, large-cap tech companies do maintain pricing power. The cushion provided by SCHD's dividends adds resilience against inflation for investors. Investors in 2025 seek diversification beyond U.S. large caps, using both VOO and CHD as foundational building blocks. The choice between SCHD and VOO is about determining their roles in your broader financial plan, often complementing each other. Together, VOO gives exposure to growth, while SCHD offers consistent cash flow, creating a balanced portfolio for any scenario. Wealth building isn't just about maximizing the number on your account statement. It's about aligning your investments with your goals. Someone in their 20s or 30s might prioritize raw growth and lean heavily into VOO. In their 50s or 60s, they might value income and stability from SCHD. The beauty of the modern ETF landscape is you don't have to choose just one path. You can combine them in ratios that match your unique needs. In 2025, if interest rates remain elevated, high dividend funds like SCHD could face headwinds as investors compare yields against risk-free treasury yields. If rates begin to fall, dividend ETFs often become more attractive. VOO's performance will be affected by corporate earnings and economic policies. Owning VOO requires a long-term mindset, the willingness to hold through downturns, and the patience to let compounding do its work. Owning SCHD also requires patience, but the psychological reinforcement of regular dividends helps many investors stick with it. Staying the course is often more important than picking the absolute best performing fund. Both SCHD and VOO have their place in a disciplined, diversified portfolio. It doesn't have to be all or nothing. Many successful investors use a core and satellite approach, where VOO is the core and CHD enhances stability and income. This approach builds wealth through growth and consistency, crucial for generational wealth. An investor who panics and sells VOO during a downturn will never realize its full growth potential. An investor who spends all their SCHD dividends instead of reinvesting them might limit the compounding effect. Discipline, reinvestment, and long-term perspective matter just as much as which ticker symbol you choose. Both SCHD and VOO are powerful tools, but like any tool, they work best when used. Imagine waking up 2 years from now, opening your brokerage app, and realizing that the money you invested has quietly been paying you every single month. No day trading, no crypto panic, just good old-fashioned cash flow rolling in while you were busy living your life. Sounds dreamy, right? Let's rewind the clock a little. It's 2 years ago, and you've got a fresh $20,000 sitting in your savings account. You're ready to make that money work. You spent hours watching YouTube videos and reading Reddit threads. One name keeps popping up, SCHD, and right next to it, Jetty. They're like the Batman and Robin of the dividend ETF world. Batman, SCHD, is the calm, disciplined type, while Robin, Jeppy, is the flashy, fun sidekick handing you cash every month. You decide to split your $20,000 in half. 10 grand goes into each, and thus begins one of the most satisfying investment experiments of your life. If you've ever invested before, you know that initial mix of excitement and mild nausea. You hit buy, and suddenly you own 130 to 140 shares of SCHD. We're talking about a basket of reliable dividend-paying companies like Pepsi and Home Depot that thrive even during recessions. Then comes Jeppy, the monthly money printer, around $55 a share for roughly 181 shares from your 10 grand. CHD is like planting a tree. Jeppy, it's like adopting a goose that lays golden eggs every month. In the first few months, SCHD drops quarterly dividend checks of around $100, while Jeppy gives you mini celebrations each month. Before long, you start treating those payouts like celebrations, buying lattes or reinvesting every penny. It feels rewarding. Isn't Jeppy too good to be true? A yield of 8 to 10% sounds suspicious, but its secret sauce isn't magic, it's covered calls. They sell options to generate extra income and pass that on to you. The trade-off? No explosive price growth. You won't see doubling overnight, Fast forward to year one, SCHD paid you around $400 in dividends, while JEPI, almost $900, more than double the cash flow. It's addictive and consistent. Your money is actually working, providing regular income. Team JEPI is high-fiving over monthly payouts, while Team SCHD appreciates their gradually rising share price. Both are winning. Then October 2024 rolls around, and SCHD drops a little surprise, a 3-for-1 stock split. One day, you own about 140 shares. The next, you've got 420. Your account suddenly looks like it's been hitting the gym. Of course, nothing's technically changed. The share price is lower, but the total value is the same. Your payout per share drops too. But because you have more shares, the total income stays roughly the same. It's all psychological. But hey, psychology matters in investing. Suddenly, SCHD feels more affordable to new investors, and that often fuels demand down the road. As the months tick by, JEPI keeps humming along, reliably dropping $70 to $80 a month into your account like clockwork. By the end of the second year, that's another $900, bringing your total to over $1,700 in payouts. Meanwhile, SCHD's price has likely crept up a bit. Maybe your original $10,000 is now worth around $11,000 or more, plus the $800 you pocketed in dividends. And this is where you have a moment. You look at your account and realize that you've been paid over $2,500 just for holding these two ETFs. You didn't chase meme stocks. You didn't try to time the market. You didn't even think about it most days. You simply set it, forgot it, and let time do the heavy lifting. Investing, if you do it right, stops being about numbers and starts being about psychology. CHD's quarterly payouts feel like seasonal bonuses, slow, steady, predictable, always trending upward. JEPI's monthly payouts become part of your rhythm, reminding you that you're building something. Reinvesting is the closest thing to financial magic we have. It grows your wealth through compounding. 2 years in, you're already seeing momentum. Imagine what happens in a decade with SCHD's 7% growth. CHD's dividend checks are fatter than ever, pushing $900 a year, and that's without you doing anything fancy. JEPI, it's been sending you consistent cash every single month, enough to cover groceries, subscription bills, or the occasional impulse vacation. When the market drops, you don't panic. You see opportunity. SCHD's dividends keep rolling in. JEPI's monthly income doesn't miss a beat. Imagine holding both SCHD and JEPI for 20 years. SCHD's payouts could exceed $2,000 a year. JEPI's cumulative income might top $20,000. Reinvest all of it, and your total wealth isn't just growing, it's snowballing into something substantial. Say you'd continued reinvesting all your payouts from both funds. That original $20,000 might now be $80,000, $100,000, or maybe more. Instead of $800 or $900 a year, you could be pocketing several $1,000s annually without adding another penny of your own money. If you've built a $500,000 position split evenly between SCHD and JEPI, you're looking at $30,000 to $40,000 in annual passive income. You don't have to sell a single share to get it. That means your capital keeps growing even as it pays you. Imagine getting a paycheck every month from JEPI, enough to cover rent, groceries, or travel. And every quarter, SCHD drops a larger, fatter check into your account, covering healthcare, insurance, or vacations. Nothing in investing is guaranteed, and pretending otherwise sets you up for disappointment. JEP's covered call strategy means its payouts can fluctuate with market conditions. Some months, the income might dip. CHD's dividend growth depends on the health of underlying companies. If corporate America sneezes, your payouts might catch a cold. When you hold both, they balance each other out. JEPI softens the blow during market dips with reliable income. SCHD provides growth and upside when times are good. Investing isn't just math, it's deeply emotional. Early on, volatility feels personal. A 3% dip feels like a failure. But when you're getting paid every month, market swings start to feel like background noise. They become opportunities. This shift in mindset might be the most underrated part of dividend investing. The consistent income stream rewires your brain. It stops you from panic selling. It keeps you focused on the long game. And it gives you something most investors never find: peace of mind. When you know that money is going to land in your account every month, it changes how you think about risk. Market dips don't feel like disasters. Instead, you start asking yourself how many additional shares you can scoop up on sale. Your time horizon naturally extends. Even a small payout becomes a reminder that your money is alive and working for you, building confidence, discipline, and patience. That peace of mind has ripple effects. You might stop obsessing over stock charts and focus on lifestyle design instead. This is what people mean when they talk about financial freedom. Options. The option to say no, slow down, and build a life on your terms. The principles are the same whether you're starting with $500 or $50,000. The key is time. Dividend investing is like planting a tree. The sooner you start, the sooner you sit in the shade. Consider investing $200 a month into SCHD and JEPI. That's $100 into each. You'd have $2,400 invested after the first year. But here's where most people underestimate investing. It's not about the size of the first step. It's about the fact that you took it. Stick with that habit for 5 years. Reinvest every payout and watch your investment transform. Those monthly JEPI payouts, they're buying extra shares every time they hit your account. Fast forward 10 years, and suddenly that small $200 habit could have snowballed into tens of thousands of dollars. This portfolio might now generate hundreds, maybe even thousands, in annual income on its own. And here's the best part. You didn't have to time the market perfectly. It's about pairing ETFs. SCHD for dividend growth and capital appreciation. JEPI for reliable cash flow. Together, they complement each other's strengths and cover weaknesses, enhancing your portfolio's performance. CHD's dividends rise while JEP provides income, making investing feel strategic. The longer you stay invested, the more this strategy reshapes your relationship with money. You stop chasing the next hot stock tip. You stop panicking when the market dips 10%. Instead, you focus on what matters: time in the market, consistent reinvestment, and a portfolio that builds wealth quietly. That's how fortunes are built, with patience, discipline, and a plan. Let's peek even further down the road. In your 20s or 30s now, starting with a modest investment. Fast forward 30 or 40 years. Those small contributions and reinvested dividends could grow into a 7-figure portfolio. It's a lifestyle, retirement on your terms. If starting later in life, focus more on the income side. JEPI's monthly payouts help cover expenses. CHD's dividends hedge against inflation, ensuring your income grows with your cost of living. They give you flexibility, the ability to pivot, adapt, and make choices without fear. The winner is the person who stays invested, the one who doesn't sell at the first dip. Wealth isn't built in weeks, it's built over decades. You don't need to pick sides between growth and income, you can have both. Let Scats build your long-term wealth, while JEPI pays you in the short term, creating a sustainable portfolio. Enjoy the journey and appreciate every payout. It's about the rush seeing the dividend received notification. Watch your wealth grow in practice, knowing your money works harder than you do. So here's my challenge to you. Stop waiting for the perfect time to invest. Stop trying to predict the next market crash or the next bull run. Pick your strategy, stick with it, and let time do its thing. Because 10, 20, 30 years from now, you'll look back at those early dividends. The ones that barely covered a dinner bill, and smile, knowing they were the first bricks in a financial fortress that changed your life. You were never just investing money. You were investing in freedom, the freedom to live life on your terms. The best time to start was yesterday, and the second best time is right now. Future you is going to be very grateful you did. If this helped you see investing in a whole...
When it comes to building real wealth through dividends, investors often focus on yield, growth, or ETF selection. But there's a quieter, more psychological question that can actually shape your success over decades. How often should you get paid? Monthly or quarterly? It might sound like a small detail, but the difference between receiving dividends 12 times a year versus 4 has profound effects on compounding, cash flow management, and even your emotional relationship with investing. Today, we're diving deep into how dividend payment frequency impacts your long-term returns and which strategy truly makes you richer. Let's start with what actually happens behind the scenes when a company or ETF pays a dividend. Dividends are simply distributions of profit. Whether they're paid monthly or quarterly, the total annual amount tends to be similar. For example, if an ETF yields 6% annually, it doesn't really matter whether that's divided into 12 0.5% payments or 4 1.5% payments. Mathematically, the yield is the same. But in the real world of compounding, cash flow, timing, and investor behavior can tilt the balance one way or the other. So what's the argument for monthly dividends? The first advantage is simple but powerful: faster reinvestment. Every time you receive a dividend, you have the opportunity to reinvest it and buy more shares. The sooner you reinvest, the sooner those new shares start earning dividends of their own. This concept, called dividend compounding velocity, means that monthly payers can slightly accelerate your growth curve because your money doesn't sit idle between payments. To illustrate this, let's take two identical $100,000 portfolios. One is invested in a monthly paying ETF yielding 6%, and the other in a quarterly paying ETF also yielding 6%. Both reinvest all dividends automatically. At the end of the year, both technically earn $6,000 in income. But because the monthly investor reinvested dividends sooner, compounding starts earlier, and over decades, that timing difference can add up. If you run the math over 20 years, assuming a constant 6% yield and full reinvestment, the monthly dividend portfolio ends up worth about $321,000, while the quarterly version ends up around $318,000. That's a modest difference, roughly 1% higher, but it's still free growth created purely by payment frequency. And when you start dealing with larger portfolios, say $500,000 or $1 million, that extra 1% can mean an additional $10,000 to $20,000 without lifting a finger. But the benefits of monthly payments aren't just mathematical, they're deeply psychological. Getting paid every month provides a rhythm that mirrors real life. Your bills are monthly, your rent or mortgage is monthly, your subscriptions are monthly. So receiving dividends monthly creates a natural cash flow loop that makes managing your finances more intuitive. Retirees especially love this because it feels like a paycheck. You're not waiting 3 months between payments. You're living on a steady, predictable income stream. This regularity can also make investors more disciplined. When dividends arrive every month, it's easier to see progress. Each payment becomes a small reward, reinforcing your commitment to the plan. It keeps you emotionally engaged, and that consistency often reduces the temptation to panic sell during downturns. In behavioral finance, this is called positive feedback anchoring. You stay invested because you're constantly reminded that your money is working for you. However, quarterly dividends have their own advantages, and for long-term compounding, they shouldn't be underestimated. First, many of the most reliable, time-tested companies in the world, think Johnson & Johnson, Microsoft, or Coca-Cola, pay quarterly dividends. That's the standard in corporate America. It's not about convenience, it's about stability. These companies generate earnings on a quarterly basis, and aligning dividends with earnings reporting makes operational sense. Quarterly payers also tend to have stronger dividend growth histories. Because they're not committing to a monthly payout schedule, they have more flexibility to manage cash flow, reinvest profits, and ensure steady increases over time. So while monthly dividends might win on frequency, quarterly payers often win on reliability and growth potential. Let's run another example. Suppose you invest in a quarterly dividend ETF like SCHD, yielding 3.8% but growing dividends at 10% annually, versus a monthly ETF like QYLD, yielding 10% but with little to no growth. After 10 years, your SCHD portfolio's income would roughly double due to compounding dividend growth, while QYLD's income would stay flat or even decline slightly if distributions fluctuate. Over 20 years, that difference becomes massive. Even though QYLD pays monthly, the growth-focused SCHD investor ends up richer, both in total portfolio value and annual income. So frequency matters, but not as much as growth rate. The power of compounding doesn't just come from how often you're paid, it comes from how quickly those payments grow. A monthly drip of stagnant income is less powerful than a quarterly payment that rises year after year. Still, there's a reason many ETF investors combine both. Monthly payers provide psychological satisfaction and cash flow stability. Quarterly payers provide growth and resilience. Together, they create a balanced ecosystem. Income consistency from one side, compounding power from the other. Let's explore how that balance looks in practice. Imagine a $500,000 portfolio split 50-50 between monthly and quarterly ETFs, half in JEPI, GPQ, or RYLD for monthly cash flow, the other half in SCHD, VIG, or DGRO for quarterly growth. Your blended yield might be around 5.5%, giving you about $27,500 in annual income. You'd receive money every month and every quarter. Those bigger payments from the growth side add a boost. It's the best of both worlds. Now, let's look at compounding from another angle, reinvestment timing. If you manually reinvest dividends, meaning you wait until enough cash accumulates, quarterly payers can actually be more efficient. However, if your platform offers automatic dividend reinvestment, DRIP, monthly payments regain the edge. The reinvestments happen automatically, often commission-free, letting every dollar start working immediately. Over 20 or 30 years, This micro-compounding adds up. It's slow at first, but relentless later. Let's dig deeper into investor psychology because this is where the debate gets personal. Some investors thrive on the dopamine of monthly income. It keeps them motivated. Others find it distracting. They see frequent payments as noise, not progress, and prefer the calm rhythm of quarterly updates. Neither mindset is wrong, but you need to understand which one keeps you consistent. Consistency is the real currency in wealth building. It doesn't matter if your ETF pays monthly or quarterly if you can't stay invested through market turbulence. The right dividend frequency is the one that helps you sleep better and stay the course. There's also an interesting nuance around financial independence. When investors start living off dividends, monthly payments simplify budgeting. You can match expenses directly with income without constantly managing uneven cash flow. On the other hand, quarterly dividends can create natural savings buffers. Since you get larger chunks less often, you're more likely to save or reinvest part of them instead of spending them. So again, it comes down to behavior. For young accumulators, quarterly dividends can encourage long-term thinking, fewer distractions, more compounding. For retirees, monthly dividends can provide smoother income and reduce anxiety. This is why the right answer changes depending on your life stage. Let's run a quick scenario comparing total income growth. Take two investors, both starting with $100,000. One invests in a 6% yield monthly ETF, the other in a 6% yield quarterly ETF. Both reinvest all dividends. After 10 years, the monthly investor ends up with $179,000, while the quarterly investor has $177,000. After 30 years, it's $574,000 versus $567,000. The difference? Less than 1.5%. So mathematically, frequency doesn't change your life, behavior does. But here's where things get interesting. When markets crash, and they always do, monthly payers can offer more psychological stability. Even if share prices drop, your income feels consistent. Those payments reassure you that your portfolio is still generating value. That emotional anchor prevents panic selling. Quarterly investors, on the other hand, can feel more anxious during long gaps without payouts, especially in volatile markets. This is one of the quiet superpowers of monthly dividends: emotional endurance. Now let's consider the total return side. Many high-quality quarterly ETFs reinvest internally and distribute profits strategically. This can lead to better capital appreciation over time, even if your income stream feels less frequent. For instance, DGRO and SCHD often deliver double-digit annual total returns over long horizons, while monthly payers like QYLD or RYLD, despite higher yields, tend to have flat or declining share prices due to payout structures. This leads to a simple but crucial insight. Yield frequency can't compensate for poor total return. Getting paid 12 times a year doesn't help if your underlying capital erodes. The real wealth comes from the combination of consistent income and asset growth. That's why sophisticated investors often design hybrid portfolios. They'll use monthly payers like JEPI and RYLD for cash flow, but anchor their core holdings in quarterly payers like SCHD and VIG for appreciation. These reinvestment-based ETFs compound more aggressively, fueling the capital growth that high-yield products often sacrifice. Think of it as an ecosystem. Income-focused funds feed your lifestyle. Growth-focused funds feed your future. And together they recycle wealth. The timing of those distributions, monthly or quarterly, simply determines how often the cycle turns.
Let's talk about something that gets investors' hearts racing: putting a fat $100,000 into ETFs. Not just any ETFs, we're looking at SCHD and VYM. You drop 6 figures into these, and over the years, they'll show you 2 completely different personalities. It's like speed dating your investments. You've got $100 grand sitting in your account, deciding where to park it. No flashy meme stocks. You're going steady. You want dividends, cash flow, and an investment that feels responsible. Not something that makes you check Robinhood at 3 a.m. That's where SCHD and VYM come in. Two ETFs, same general vibe, dividends, stability, but their execution, night and day. Let's give these funds some human qualities because you'll remember them better. SCHD is like that sharp-dressed friend who knows the good restaurants. CHD screens for quality companies and strong fundamentals, never settles for less. It's selective, maybe even a little snobby. VYM, on the other hand, is your dependable workhorse buddy. He shows up with beers, wants everyone included. VYM casts a wide net, holding hundreds of companies, and focuses on steady dividends. It's less exclusive and all about inclusion. Now split your 100K, left for SCHD, right for VYM. Both will start sprinkling cash into your account with dividends. But SCHD handles payouts aggressively, growing faster than your cousin's side hustle excuses. VYM starts out higher on the yield side. It's not promising rapid growth, but it delivers a solid baseline, like a comfortable starting salary. The pay is reliable, the hours are stable, and you're not stressed. Now zoom in on SCHD. This ETF cherry-picks stocks that pay dividends and grow them. Companies like Pepsi, Texas Instruments, and Amgen. Investing in SCHD is not just about the current yield, it's about future income growth through reinvestment over the years. Think of it like planting an apple tree. You start with a couple of apples, and over 20 years, you could run a mini orchard. VYM says, why stress over picking winners when I can just own them all? This ETF spreads your 100K across over 400 companies. It's not trying to be fancy. It provides stability through diversification, including companies like Johnson & Johnson and Exxon. Like a Costco membership, VYM offers value, variety, and predictability instead of artisanal picks. The yield is similar to SCHD and may offer more cash in year one, appealing to those who care about immediate income. In comparison, SCHD is the ambitious friend, while VYM is the steady coworker. Both stable, but with different approaches to money. With your $100,000, do you want to maximize future income potential or feel secure with wider distribution among dividend payers? It's a personality test disguised as Investum. Some people love SCHD because they want dividends to grow faster than inflation. Others prefer VYM's wide reach because they feel safer owning a little bit of everything. It's all about investor psychology. Do you want the thrill of watching your payouts grow aggressively, or feel like your money is diversified enough for market chaos? No ETF is bulletproof. SCHD can be more concentrated, and that can work against it sometimes. VYM's diversification exposes you to a wider set of risks, but both are excellent funds. 100K in either isn't a bad choice. The only mistake would be overthinking it so much that your 100K just sits in cash while inflation eats it alive. Imagine you've dropped that 100K in both SCHD and VYM. At first, not much difference. Both are dripping dividends into your account. Both look stable, and you feel like a genius for not falling for the Dogecoin hype. As the years pass, little differences compound. SCHD's dividend payouts are like they've had 3 shots of espresso every year. Your income stream morphs from $3,000 in year 1 to money that feels like rent money. No constant trading, just a reinvest and chill strategy. Now flip to VYM. In year 1, you're pulling in more cash than SCHD, a nice comfortable $3,500 to $4,000. But over time, you'll see the trade-off. VYM's dividends move up slowly, like someone on an escalator. Historically, SCHD has outpaced VYM in total return, thanks to its emphasis on companies that grow and reinvest efficiently. You get stronger dividend growth, and your portfolio value itself tends to stretch a little faster compared to VYM. VYM offers stability and coverage, doing its job with a steady dividend check, but it rarely blows your socks off. Owning SCHD feels like having a friend who keeps getting promoted every couple of years. Owning VYM feels like that reliable buddy who's been at the same company for 20 years, safe and dependable. Those little differences in growth rates start snowballing in ways you don't notice until it's too late. A couple of percentage points in dividend growth might not sound like a big deal, but in a decade, SCHD could surprise you with bigger checks. Meanwhile, VYM is still writing decent checks, just not the kind that make you grin ear to ear. Psychology plays a huge role here. Some investors love upfront income with VYM, feeling comforted by it. Others prefer SCHD's dividend growth curve, willing to wait for the bigger snowball down the hill. So when people ask, which one is better? The answer is, it depends on who you are. CHD is more concentrated, holding fewer companies. That's what allows it to be picky. But it also means if a few of its top holdings take a hit, you'll feel it more. VYM spreads your money across hundreds of stocks, so no single blow can really rattle it much. If SCHD is like a hand-selected gourmet restaurant with 30 items on the menu, VYM is the all-you-can-eat buffet with 300 choices. If you're a long-term reinvestor, the gap between these two gets even more dramatic. Reinvested dividends are like cheat codes for compounding. CHD's faster dividend growth means every reinvested dollar starts pulling its weight harder over time, while VYM gives you more kernels, but at a slower rhythm. Historically, SCHD has edged out VYM in total return thanks to its focus on quality and dividend growth. That 100K in SCHD could grow larger than the same amount in VYM, with the dividend gap widening too. VYM isn't trying to be flashy. It's the steady foundation, built for stability. You get two different experiences. SCHD is a dividend growth machine, while VYM offers broad diversification. If you like wide diversification, VYM will help you sleep better. If you want faster growing income, SCHD is your pick. Think of it as balance. One friend pushes you to hustle, the other reminds you to slow down. So 100K in SCHD is like strapping into a sprinter, while 100K in VYM is like settling into a marathoner's steady pace. Both get you to financial freedom. The choice is simply which stride matches yours. So here's where I'll leave you. Which style fits you more? Do you see yourself leaning toward the ambitious, dividend-growing energy of SCHD or the broad, steady reliability of VYM? Think about it, because the answer says more about your personality as an investor than it does about the funds themselves. Drop your answer below, and while you're at it, hit the like button, subscribe, and stick around for more breakdowns like this.